delivered fresh to your inbox. The Market Call Top Picks newsletter. Sign up at bnn.ca.
Even though our next guest says U.S. and European data keeps getting better, she's still in defensive mode with an eye on the technical backdrop. Joining us is Diana Avigdor, Vice President and Head of Trading at Barometer Capital. Good morning, Diana. Thanks for joining us this morning.
Thanks for having me.
When we look at the economic data, especially in the U.S., it's been incrementally stronger. Why are you still kind of on the defensive fence, as it were?
The stories on the bull side and the bear side, I feel, are almost equal. You can possibly now argue both sides almost with the same intensity. What happened with the long-term repo operation last week in Europe provides a positive backdrop in terms of the European issue, the fact that they're refinanced, and that has been a big problem. But on the other hand, we have the negative sides as well still. You see the performance, the best performance of the sectors that have done well this year are still in defensive mode. And given rates being the way they are, the yield products are still very, very attractive. We are coming into a technical formation that has been rejected twice before. The 200-day moving average on the S&P, we're nearing that now. And though I started hearing conversations about the Golden Cross, which we've seen last summer, that it may happen again, we can't project forward technicals. So I think that sometimes technicals are secondary in the way I look at things, but sometimes they are more important. And right now, as you know, at Barometer, we don't really predict forward. We like to see things as they happen and act on it. Right now, we'd like to see this breakout first before getting more constructive. However, I think the yield theme is still very strong here, and we're going to stay with that. Though we at Barometer, we're just going to stay unhedged, perhaps, and stay long the names that we really like, that are yield-producing names.
Well, what about the sectors that have been beaten up a little bit more than others? What about small caps? What about golds? Right. What about opportunities for perhaps a little bit of value? Are you ready to step into that sort of area yet?
I think that from a short-term trading perspective, and I'm not talking about the longer-term positioning, but for those that want to put on a short-term trade and are able to take on and willing to take on a little bit of risk, these junior golds and golds in general have really been beaten down. One of the themes for year-end in the market is, buying winners and selling down the losers. There's been some tax loss selling for sure. And so some of these junior golds have really, and golds have been beaten down. In addition, you see large cap energy names have also fared very badly this year, despite the fact that oil is actually up around 8% year to date. There could be a trade there where you buy the larger cap oils just on the rebound. So in addition, you've seen the VIX index. It's extremely low. The last couple of weeks we've seen the VIX go down even when the markets have been down or sloppy. So the volatility indexes has by some technical nature is being held down partially by rollover into January contracts. But I think there is an ETF called VXX in the U.S. that could also be an attractive short-term trade to go long. Just expecting not necessarily to make a call on the market, but just expecting volatility to increase come the new year.
And let's talk about put China into the mix, because you talked about energy in particular. Maybe there's an opportunity in big cap oil. How does China fit into the mix? Because obviously those equity markets there have been very weak. All everybody's concerned about is the economy next year in that country.
That's right. So China is one of the issues that we're watching. That's in the bear camp. That market has just not been able to rally at all, while North American markets and European markets have done better. So one of the reasons that perhaps it's being kept low is there is expectations. Traders are chatting about expectations that there's going to be another rate cut in the next week and a half. Recall that last Christmas Day, China actually raised rates on the 25th of December. They like to do this when markets are closed for longer periods of time. So there is a fear that there is going to be another rate cut. And if China slows, of course, that's not a positive data point for oil markets. You know, as U.S. is coming back online, and if Europe fixes its issues and only has a recession as opposed to something worse, and if Japan, you've seen the yen weakening ever so slowly, and if the yen weakens, then maybe the Japanese stock market comes back online a little bit. It's possible that China may be offset, and who knows, this could be just a temporary balanced slowdown. So, but this is what we at Barometer want to see. We want to see these things clarify a little bit, the technical backdrop, the reason China is not acting that well.
We will be watching all of those over the next couple of weeks and, of course, into the new year. Thank you very much for joining us, Diana, and happy holidays.
Happy holidays. Thank you.
Diana Avigdor, Vice President and Head of Trading at Barometer Capital. She joined us from the TMX.
Coming up, Bombardier has landed another German train order. Paul Bagdo has the details.
Have some